Listen here, the holidays are upon us, and I'm going to tell you something most traders won't admit until they've blown up their accounts for the third time. This season, when markets thin out and volume drops like a stone in still water, is when more fortunes are lost than made. And I should know. I've made millions and lost millions, sometimes in the same year, and the hardest lessons always came when I thought I was too smart to follow my own rules. You see, the market doesn't care that it's December. It doesn't care about your year-end bonus or the bills stacking up after Christmas shopping. The market operates on its own terms, always has, always will. But here's what changes during the holidays. Liquidity dries up faster than champagne at a New Year's party. The big players, the ones moving real money, they step away from their desks. What you're left with is a skeleton crew of traders and algorithms that can whipsaw prices on volume so thin you could read a newspaper through it. I learned early in my career that the market has different personalities at different times. Summer doldrums, holiday seasons, these aren't just calendar events. They're shifts in the market's character, and if you don't adjust your strategy, you'll pay for that ignorance with real money. The $1 million reset rule I'm about to share with you cost me exactly that to learn. Not once, but twice, because apparently I needed to lose a fortune before the lesson stuck in my thick skull. Here's the rule. Between December 15th and January 2nd, you cut your position sizes in half, you widen your stops, and you treat every trade like you're walking on ice in the dark. I don't care if you've been on a hot streak since October. I don't care if you've spotted what looks like the setup of the century. The market during the holidays is not your friend, and it will punish overconfidence faster than you can say Merry Christmas. Let me paint you a picture from my own experience. It was December of 1916, and I'd had a phenomenal year. I was reading the tape like a master musician reads sheet music. Everything I touched turned to profit. The war in Europe was creating opportunities left and right, and I was capitalizing on every one of them. By mid-December, I was up more money than most men see in a lifetime, and I had this feeling, this dangerous feeling, that I'd finally figured it all out. The week before Christmas, I spotted what looked like a magnificent short opportunity in a railroad stock. The chart was perfect, the volume was confirming, and every fiber of my being said this was the trade. But here's what I ignored. Trading volume had already dropped 40% from normal levels. The bid-ask spreads were widening. The tape was moving in a jerky, unnatural way that should have told me the real players had already left the building. I went in heavy, too heavy, betting the same size I'd been using all year when the market had proper depth and liquidity. For 2 days, nothing happened. The stock just sat there, barely moving, which should have been my second warning. Then, on the day before Christmas Eve, with practically nobody at their desks, someone dumped a large block of shares at market, and the stock spiked up 3 points in 15 minutes on volume that wouldn't have moved it 30 cents during regular trading conditions. My stop got hit, and I was out with a loss that erased 2 months of careful profits. The stock then drifted back down over the next week, proving my analysis had been correct. My timing and position sizing had been dead wrong. That's the cruelty of holiday trading. You can be right about direction and still get carried out on a stretcher because you didn't respect the changed conditions. Now, some of you are thinking, but that means I'll miss opportunities. You're absolutely right. You will miss some moves. You'll watch stocks make moves during thin holiday trading that you could have caught if you'd stayed fully engaged. And you know what? That's the entire point. The $1 million reset rule isn't about catching every wiggle in the market. It's about survival. It's about being around in January when the real money comes back to the table and the game starts again in earnest. Here's what you need to understand about human psychology and the markets, especially during the holidays. You've got 2 forces working against you. First, there's the calendar pressure. You're looking at your year-end numbers, and if you're down, you're feeling desperate to make it back. If you're up, you're feeling invincible and want to pad those gains. Both emotions are poison. The market doesn't care about your calendar year. It doesn't reset on January 1st. Those are human constructs. And the moment you start trading based on calendar pressure rather than market conditions, you're finished. Second, and this is more subtle, The holidays mess with your routine. You're distracted. Family obligations, parties, travel. Your head isn't fully in the game, even when you think it is. I've watched myself make careless errors during holiday weeks that I'd never make in April or September. Entering orders wrong, misreading the tape, forgetting to set stops because I'm rushing out the door to some dinner I don't want to attend. These aren't market errors. These are life errors bleeding into trading, and they'll cost you just as surely as any technical mistake. The reset rule works like this, and I want you to write this down because it's worth more than any hot tip you'll hear this season. Starting December 15th, you take your normal position size and cut it in half. If you usually trade 500 shares, you trade 250. If you usually risk 2% per trade, you risk 1%. This isn't about being scared. This is about being smart. You're adjusting to changed market conditions the same way you'd adjust your sail when the wind shifts. Next, you widen your stops by 50%. If you normally use a 2-point stop, make it 3 points. Why? Because in thin markets, prices can gap and jump in ways they don't when liquidity is normal. A stock might drop 1.5 points, take out all the tight stops from amateur traders, then reverse and go exactly where you expected it to. In normal conditions, that stock might have only dipped 0.5 point. You need to give your positions room to breathe in the holiday chop. Third, and this is critical, you cut your trading frequency. If you normally make one trade a day, make one every 2 or 3 days. Be more selective than you've ever been. You're looking for only the absolute best setups, the ones so obvious that a child could spot them. Everything else, you let pass. Remember, the best trade is often the one you don't make. During the holidays, that's doubly true. Fourth, and this is where discipline separates winners from losers, you set a hard stop loss for the entire period. Let's say you're up 50,000 for the year. You decide right now that you will not let your account drop below 45,000 between now and January 2nd. If you hit that number, you're done. You close everything and you walk away until the new year. No exceptions, no just one more trade, no nothing. You're finished. That $5,000 is your insurance premium against doing something catastrophically stupid when your judgment is compromised by eggnog and family drama. I can't tell you how many traders I've known, good traders mind you, who had stellar years and then gave back 20 or 30% of their gains in the last 2 weeks of December, trying to squeeze out just a bit more. It's heartbreaking to watch, and it's entirely preventable. The market will be there in January. It's been there for hundreds of years, and it'll be there hundreds more. There is no trade so good that it's worth risking your whole year's work in the period between Christmas and New Year's. Now let's talk about the psychology of the reset itself. When you implement this rule, something interesting happens. You stop trading like you're desperate. You stop trading like you're greedy. You start trading like someone who's going to be in this game for the long haul. Someone who understands that preservation of capital is the foundation of everything else. And paradoxically, when you trade with less size and less frequency, you often make better decisions because each trade matters more and you give it the attention it deserves. I remember January of 1917, after that painful December lesson. The market opened for the new year, and within 3 weeks, I'd made back everything I'd lost in that stupid holiday trade and then some. But here's the thing. I could only capitalize on those January opportunities because I hadn't blown myself up completely in December. I had capital to deploy. I had my confidence intact. I was clear-headed and ready to work. How many traders miss the best opportunities of the new year because they're either broke or so psychologically damaged from December's losses that they can't pull the trigger when they should? The reset rule also forces you to do something else that's valuable. It makes you review and plan. When you're not frantically trading every day, you have time to look at your full year's results objectively. What worked? What didn't? What patterns did you fall into that cost you money? What edges did you develop that you can sharpen? The time between mid-December and early January should be partially dedicated to analysis and preparation, not just grinding out trades in the worst market conditions of the year. Here's another element most traders miss. The holiday period is when you should be building your watch lists for January. You should be identifying the stocks that are setting up, marking your levels, planning your campaigns. The real operators, the ones managing serious money, they're doing this work while amateur traders are frantically trying to day trade the holiday chop. Come January, when volume returns and institutional money flows back in, you want to be ready with a battle plan, not scrambling to figure out what to trade. Let me address a specific trap that catches people every single year, the January effect. You've probably heard about it, this supposed tendency for small cap stocks to outperform in early January due to tax loss selling in December and reinvestment in the new year. First of all, like most market patterns, it's not nearly as reliable as the textbooks make it sound. Second, and more important, the setup for any January effect play happens before the holidays, not during them. If you're going to position for early January strength, you do it in late November or early December. You don't do it on December 28th when you're trading against thin air and algorithm ghosts. I've seen traders convince themselves they're being strategic by taking large positions right before year end, telling themselves they're getting ahead of January buying. What they're actually doing is exposing themselves to maximum risk during minimum liquidity. That's not strategy. That's gambling. And gambling dressed up in smart-sounding logic is still just gambling. There's also this phenomenon during the holidays where bad news gets released after market hours or right before long weekends. Companies know fewer people are paying attention. If you're holding positions through the holidays, especially in individual stocks rather than broad indices, you're exposed to headline risk when your ability to react is limited. I've learned to be very cautious about holding anything that could announce negative news when I might be away from my desk for an extended period. The market has a cruel sense of humor about when disasters strike. One more thing about the psychology of all this. Implementing the reset rule requires you to admit something that's hard for aggressive traders to admit. You have to acknowledge that you don't need to always be fully deployed. You don't need to maximize every single day. There's a time to press your bets, and there's a time to pull back and protect what you've built. The best traders I've ever known, the ones who lasted decades and built real wealth, they all understood this rhythm. They knew when to be aggressive and when to be defensive. December and early January are defensive times. It doesn't matter what the market is doing. It doesn't matter if it's rallying or selling off. The conditions themselves dictate a defensive posture. When liquidity returns, and the major players come back to their desks in mid-January, then you can think about getting aggressive again. But not before. The market doesn't reward you for being a hero during the holidays. It punishes you for not respecting the changed environment. Let me tell you about my second $1 million lesson, because apparently I'm a slow learner. This was years after that 1916 debacle, and I thought I'd learned my lesson. I had learned it, actually, but I got complacent. Had a few good holiday seasons where I followed my rules and nothing bad happened. That's dangerous, you see. The market lulls you into complacency by not punishing you immediately for every mistake. It lets you get away with things until you've scaled up your risk enough that the eventual punishment really hurts. So there I was, Christmas week, and I spotted what I was certain was a major move developing in the commodity markets. All the signs were there. The fundamentals were screaming. The technical setup was textbook, and I convinced myself that this was different, that this opportunity was too big to trade small. You know how this story ends. I went in with full position size. The market went sideways for 3 days on no volume, and then when trading resumed after the holiday, the whole thing reversed on me before I could properly react. Another massive loss, another expensive reminder that the rules exist for a reason. That's when I made the reset rule absolutely sacred. No exceptions, ever. I don't care what I think I see. I don't care how certain I am. Between mid-December and early January, I trade small, I trade infrequently, and I'm defensive, period. That rigidity saved me more money over the following years than I can calculate. The opportunities I missed during holiday weeks were nothing compared to the disasters I avoided. Here's something else worth considering. Your competition during the holidays isn't the same as your competition during normal market hours. The smart money is gone. What you're trading against is other restless traders who couldn't stay away, algorithms running automated strategies, and market makers widening their spreads because they know they can. None of these participants are going to give you a good price or a fair shake. You're operating in a degraded environment, and unless you're adapting to that reality, you're at a severe disadvantage. The $1,000,000 reset rule is ultimately about self-awareness. It's about understanding your own limitations as a human being trying to make rational decisions during a time of year that's designed to be irrational. The holidays are emotional, they're exhausting, they mess with your sleep schedule and your eating habits and your stress levels, and you want to be making high-stakes financial decisions in that state? You want to be risking serious money when you're operating at less than your best? That's madness. I'm not telling you to stop trading completely. If you do that, you might miss the routine, lose your rhythm, come back rusty in January. What I'm telling you is to trade like someone who understands the game has temporarily changed. You're playing on a different field with different rules, and if you don't adjust your strategy accordingly, you're going to get hurt. It's not a matter of if, it's a matter of when and how much. This season, make yourself a promise. Write it down. Tell someone about it so you're accountable. Promise yourself that you will implement these rules. Half position size, wider stops, less frequent trading, and a hard stop loss on your total account. Promise yourself that you'll use this time to review, plan, and prepare rather than trying to squeeze every last dollar out of thin holiday markets. Promise yourself that you'll come into January rested, capitalized, and ready to work rather than broke, demoralized, and shell-shocked. The market has been here for a long time. It'll continue to be here. There's no shortage of opportunity if you're patient and disciplined enough to wait for good conditions. The worst thing you can do is force trades in bad conditions just because you can't sit still. I've made that mistake more times than I care to admit, and every single time it cost me. Learn from my expensive education. Implement the reset rule. Protect your capital and your psychology during this treacherous period. January is coming. Real volume is coming. Big money is coming back to the table. Be there when it does, with your powder dry and your head clear. That's how you win this game over the long term. That's how you build real, lasting wealth in the markets, not by being a hero in December, but by being smart enough to survive December so you can capitalize on January and all the months that follow.